I want trend identification. That's our first component of our market cycle system. No system in the markets will be perfect. There will always be systematic chop in your cycle counts, and you have to factor that into how you want to build your system.
You can stack different layers to your market system that will make it more robust and also more effective. You have to start somewhere, and you basically want to start with a very simple trend system and then build off of that as you gain experience.
There's no such thing as give me a system that will work 100% of the time. If it was that easy, there would be no stage 1, 2 traders in this world. We would all be stage 3, working from home 9 to 5, trading the market. Life will be great at that point. Okay, so let's start with the very basics. So what I've done here is put up a chart of S&P. You could choose any market. You know, traders say, hey, I'm a growth trader and I only want to benchmark myself versus the Qs. You could definitely do that. This is just for, just to build a simple example of what a market cycle system can look like. So step 1 is you just pick a market. So I just picked the S&P. You could pick any market that you want. This is international. This is not related to S&P whatsoever. So you pick a market, and let's say we just put an MA on this. I'll let you guys guess what MA this is, but let's just say this orange line is some sort of moving average that I put onto the S&P 500. Now, this is a simple trend line market cycle system where what I can say is when the S&P is above the rising, I gave it away, 21-day moving average, it's a positive cycle. And when the S&P is below this 21-day moving average, it's a negative market cycle. So those two things alone, right? Above, below, and we'll get into the details in the next slides. This is a very simple trend line based market cycle system, right? Now, if we get to the next slide, what we could say is I want trend identification. That's our first component of our market cycle system. Trend identification means when I'm below this moving average, I've colored that red. So that's a negative market cycle according to my definition. And when I'm above the 21-day, it's a positive or a upcycle in my market cycle system. So that's the second component of it, is the trend identification. Now, I've labeled those as this is when the S&P traded below the 21-day for 20 days in a row. So that's a minus 20. That's the second thing that we talked about, the cycle count. This is a minus 20 cycle count, whereas this is a plus 21 day upcycle in the markets. Now, what we've done so far is the very basics, right? We pick a market that aligns with how we want to trade. We've introduced a simple trend identification system based on the 21-day SMA. Then we've kind of labeled and said this is a 20-day negative down cycle, and this is a 21-day positive upcycle. So now we've gone through the first 2 steps of building our market cycle system. This is step 2, the cycle count. We've added that to the charts. Now, the third is what I think is the most important, and what traders tend to get away from, is that no system in the markets will be perfect, right? It looked like, hey, this works very well. We have a minus 20, plus 21. I'm good to go. I will never see chop. And I saw the word chop, which is like kind of very similar to what we have in the existing market, depending on what kind of trend identification system you have. But there will always be systematic chop in your cycle counts, and you have to factor that into how you want to build your system. There's no such thing as give me a system that will work 100% of the time, has no system chop. If it was that easy, there would be no stage 1, 2 traders in this world. We would all be stage 3, working from home 9 to 5, trading the markets, and there's, the life will be great at that point. But account for system chop, where now at this point you see we're above the MA, we're below the MA, we're above the MA, we're below the MA. So how can we improve our system? How can we improve our market cycle system to kind of account for this chop? That's where other components come in. What are the number of setups that I see? What does, for example, breadth look like? Some people use sentiment. What does sentiment look like in that period? So those additional components that you could attach to your market cycle system will allow you to navigate the system chop. Whereas when it gets easy and we break the MA, it's very obvious. Number of setups is low. What we see in the market is, things are just left and right getting, slaughtered, and we have an easy downtrend. At that point, your market, identification system, your market cycle count will also be negative. And that's the easy part. This is what we want to kind of focus in on. And, how do you add those additional, 1 or 2 parameters? Some traders add too much. I used to add too much. I used to use sentiment book, put call ratio, NYSI, the Nasdaq McClellan oscillator. I used to have, and then a volatility indicator. So I used to have 4 or 5 additional parameters to my market cycle. That was way too much. Try to focus in on keeping it simple. We'll get into that a little bit later, but in this system chop, this is a reality. It will happen. You have to come to terms with the fact that this will happen for any market cycle system that you build. Even Stan Weinstein's system, when you chop around a stage 3, can turn back into a stage 2 if it goes back into a rising 30-week rising moving average. So I wanted to make sure we point this out. This is not about perfection. It's about building some sort of, boundaries for yourself to define uptrend, downtrend, but keeping in mind that we will have systematic chop. So next, I just put on, there was then a 46-day upcycle. So once the market reclaimed the 21-day, now the 21-day is rising at this point. We have a 46-day upcycle, which ended when the S&P again broke below the 21-day moving average. So with that, we'll get into a little bit of step 3. So step 3 is about, I guess, any questions on the cycle count before we go on to stage or step 3.
And as people are leaving their questions, please drop a few in here. I'll ask this, right? How should people think about the cycle count in real time? How will they know whether it's going to be a clean down cycle versus a clean up cycle versus just chop? What can they do in real time to navigate that?
So the third aspect of it, which is journaling each day of that cycle count, will give you a very clear idea. So it could be, hey, these themes in the markets exist, or we've had a stress test and now we're anticipating that the next move the market's going to make is to the upside, or the market is in an upcycle, but I don't see the number of setups being enough for me to trade, or I don't see maybe a breadth metric that I follow not being high enough, right? So something like John Boyk uses 3 consecutive days in a row of net high lows being positive for him to then have, a positive stance on the market. So that's kind of like a threat, like a circuit breaker type of approach. Hey, I need to see this 3 days in a row at the very minimum for me to then justify that, yes, my market cycle isn't, is positive, but then now I anticipate that I'm out of this system, the chopping phase of being around an MA, or the chopping phase of net high lows flipping back and forth, right? So he uses that as kind of like a parameter for him to get very bullish on the 4th day, for example, of that. Another way is you could just, I big on scanning the market. Once you scan the market, you will get the best feel for what's going on. So if you can identify and you have your focus list, it's hard to contain your focus list to less than 10 stocks. That's a positive, right? That's especially you're early in the cycle. You're early in your market cycle count. You see a whole bunch of setups at the same time, and you line those things up together, then you'll have a net bullish or positive stance on the market as well. So those are a couple of ways. We'll get into those in the later slides as well.
Yeah, and there's a question how to count the cycle count. Basically, what you do is whenever your system, however you define that, starts a down cycle or starts an up cycle, you start counting. The first day down is -1, all that. And then once the upcycle begins, it's the same thing on the flip side. Anything to add about people tracking the counts, right?
Yeah, that's the third step.
Yeah. I'll add before we move on.
Yeah.
Ross is huge, in how he defines cycles. He's always talking about quantitative element as well as the qualitative element. So the quantitative is your hard and fast rules. This is what signals a new uptrend. This is what signals a new downtrend. But then that qualitative factor is what Rye was more getting into, where in addition to those hard and fast rules, what else about the environment is informing me about, is this a environment that is conducive to my style? Are there a lot of setups? Are setups working? Are they following through? Are breakouts holding? Are pullbacks holding? All of that versus, you know, the trend system, the whether that's based on the QQQ, the SPY, whatever. That could be in an uptrend, but there could be no setups out there. A lot of stuff could be breaking down, turning. So there's always additional elements that you can add to your system. We're starting very simple because that's how you should start. But as you gain experience, journal more, study history, identify what themes are working at different times, you can stack different layers to your market system that will make it more robust and also more effective. But you have to start somewhere, and you basically want to start with a very simple trend system and then build off of that as you gain experience.
Awesome. So let's get into step 3. So keeping a log of your market cycle will help you spot patterns. I've said this a couple of times now. And if we break that down into, you know, what it will allow you to do is when your position size should be the highest, you can anticipate when the market is going to start to, you know, kind of be a little bit stretched, and you anticipate that things are going to pull in, which is what we call a stress test. How multiple stress tests will lead to a trend change in your, you know, in your market cycle. So if you we're 10 days up in a positive market cycle, you can start to expect that we're going to see some sort of pullback, and that's what we can call a stress test, right? We're let's say Nvidia and a whole bunch of what you can define as leaders have moved up, and now there's going to be some sort of consolidation, and that's what healthy markets do: consolidate or pull back to, let's say, a rising 10-day moving average. Those stress tests, if there's one of them and then the market stabilizes, is good. If you get 3 of them back to back, it's going to break the back of the market, and it's going to likely lead to a trend change from a positive market cycle to a negative market cycle. The third benefit is it will allow you to reduce your position sizes late in the market cycle. So if we're in a 46-day uptrend and your position sizing is exactly the same as it was early in the market trend, in a positive market cycle, it's going to hurt you eventually, because as we get later on into the market cycle, if your position sizes continue to remain the same or higher, the way the math works is when the market has that pullback or changes from that positive trend to negative, you're going to get hurt equally as much as you were, you know, benefiting from the market when the market cycle started. So as we get later on into a market cycle, you want to reduce your position size, because then the chances of failure or trend reverting back to a negative one is higher and higher. And you want to reflect that in your position size so that when you're hurt later on in the market cycle, like I say, there are no good trades in the market. All of them feel bad when you sell out of them, even if you're up 30, 40, 50%, because you give back that last, 5 to 10% off the top, right? So they will allow you to reduce your position size. You'll learn about the market environment a lot more. So you'll naturally, as you journal, build these mechanisms of, hey, I want at least 2 days of my market cycle to be positive for me to start getting very aggressive in the markets, right? So you learn about the market environment. The more, cyclical you get or repetitive you get by tracking and journaling your market cycle. You keep a historical diary of the themes. I think that's what this one's most important. So I have a full log of, at least 3.5, 4 years, maybe even more somewhere else. And I moved more digital. It used to be a little bit more, handwriting and all of that stuff in a notebook, but it will give you, hey, you could go back in time and say this state of the market reminds me of some very similar state that I was in a couple of years ago. And that is powerful. Like that type of information to be in your head and readily available for your market cycle system is a very powerful component where you could, keep kind of a journal of what was going on back in time and how you could relate that to the current market. It also boosts your mental game. You will feel more prepared. You will trust. You'll build that trust with your own market cycle system, and that when your mental game gets a boost, your confidence goes up, and naturally your decision making will be very, very good because you're not self-doubting yourself. You're just trusting what you've built in terms of the market cycle system you have, and you're repeating that over and over. And trust, confidence, and this, your mental game being very high or optimal is a huge thing in terms of performance in the markets that stage 3 traders exhibit, right? Stage 3 traders are focused on performance, whereas stage 1 and 2 traders need to focus on process a lot more. And that's why we're focusing on the process of market cycle. And we'll get into performance in later webinars. So what do we need to track? So all of that stuff, just boiling that down into, very simple. If you don't have a market cycle system, you could just start very simple, pull up a Google sheet, Excel sheet, no excuses, could be a notebook, right? On your desk, just a piece of paper, and you just track, have a trend identification system, start your cycle count, and start tracking some metrics that you see. So what I tend to track is when stress tests are happening in an uptrend. When I see multiple stress tests come together, I get a little bit cautious because that should not be happening in solid uptrends. In downtrends, you want to track the opposite, which is short covering rallies. You want to track themes that are developing in the market, and we'll get into a real market cycle example, the negative 60-day market cycle that we experienced in 2022. And then you want to write the repetitive or cyclical nature of the markets. Hey, people say, the Fed is reporting, and they tend to say there's always a shakeout, right? There's always something happening around Fed days. You could build that right into your market cycle system, right? And you could say, is this something based on my trend identification and my cycle count? Am I seeing this behavior in the markets again and again? If so, then you could improve your market cycle system just based on that observation that you make from one cycle to the next, or over let's say a span of 10 or 15 cycles, and then you improve your system gradually.